Mortgage applications rise for the fourth straight week as rates drop to their lowest levels since September 1st, while refinancing activity suffers its biggest drop in 6 weeks. Fed Chair Jerome Powell sends investors a stern warning against premature rate cuts, to which investors paid little attention as they continued to push bond yields lower. And Gen Z outpaces millennials and Gen Xers in homeownership, just trailing behind the baby boomer generation. Welcome to the REECON Report. I'm Simon, an investor and licensed real estate agent. My goal is to bring you the most relevant news and information in economics and real estate to help you better understand and navigate the housing market. Don't forget to like and subscribe to make sure you're informed and up to date on the latest information. Let's get started with an update on mortgage rates. They're still high. Moving on. I'm just joking, but not really. Borrowing costs have come down slightly in the last couple weeks, bringing home buyers out of the woodworks. Mortgage applications trended upwards over the course of the past 4 weeks, giving us the longest stretch of gains since March of this year, up 4.7% as of last week, with an average loan amount of $403,000, the lowest since January of 23 this year. The reason why the average loan amount has been trending lower is, of course, due to stubbornly high property values combined with rates last seen since George W. Bush was in office, pricing borrowers out of some areas towards more affordable housing options commensurate with their income requirements and the money they have available to put as a down payment. It's important to note that mortgage applications are still down 20% year over year despite the drop in rates. Furthermore, it should be no surprise that refinancing activity practically died in the last 6 weeks, barely showing a pulse, much like someone currently residing in the White House. Fed Chair Jerome Powell stated this week that, quote, "We are prepared to tighten policy further if it becomes appropriate to do so," end quote. He warned investors not to get their hopes up that the Fed would be finished with rate hikes and could possibly cut rates into 2024, saying, quote, "It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease," end quote. Translation, don't hold your breath. In our last video, I discussed the relationship between the 10-year Treasury note and the 30-year fixed mortgage rate. Well, as it happens, over the last 30 days, there has been a string of poor-performing bond auctions, which could indicate a rising tide for the 10-year Treasury yield. The recent trend in the 10-year bond yield has it plummeting to a mere 4.19% annual return, thanks to bond dealers picking up the slack where end-user demand continues to decline, with the 30-year fixed mortgage rate closely mirroring those movements. As the S&P, Dow Jones, and NASDAQ indices continue to rise, signaling a market shift towards risk, the bond prices will continue to suffer, forcing the Federal Reserve to intervene with tighter monetary policy, possibly pushing rates even higher just to draw investors back into the bond market. I think it's entirely possible that we see the 10-year reach yields above the 5% mark sometime in the first half of 2024. Since we're on the topic of Treasury bonds, China has been systematically selling off U.S. Treasuries at what would seem to be an alarming rate. Upon closer investigation, it would seem China has been swapping out Treasury bonds in exchange for agency bonds, a similar type of investment vehicle yielding a higher rate of return, just a little higher than Treasuries, with a slightly higher risk profile, as they are often issued by entities like Fannie Mae, Freddie Mac, the Federal Housing Administration, and the Small Business Administration. Unlike Treasuries, not all agency bonds are issued by government agencies, and therefore may not be explicitly backed by the full faith and credit of the US government, requiring a higher risk tolerance from investors. All this is to say China must be fairly confident in the US housing market to make such a big bet. They're betting billions of dollars in agency bonds over their safer, lower yielding cousin, US Treasury bonds. I've said it before, and it bears repeating. If mortgage rates, as a result of falling bond yields, continue to decline week after week, the impact on home prices will be seen almost immediately. If the Federal Reserve decides to preemptively cut rates to avoid the hard landing that we all know we're headed for, the housing market will see a resurgence of new money pushing valuations higher and first-time home buyers out of the market. It seems to me there's an opportunity to make some decent returns in 2024 by simply taking advantage of today's home prices and raking in the equity as rates come down. Let's move on. Gen Z, and this is a really interesting tidbit of information here. I think you're going to like this because it might just change the housing market moving into the future, at least the way we buy and sell real estate. But here's what's happening. Gen Z has outpaced millennials in homeownership, according to a Redfin study. Roughly 30% of 25-year-olds in 2022, just last year, we're talking about Gen Zers, owned their homes, compared to 28% of millennials who own their homes at roughly the same age. Millennials have been dubbed the financially unlucky generation for entering the workforce during the 2001 recession and then having to contend with the 2008 mortgage crisis. It's no wonder the jaded generation of the millennials prefers the haven of government bonds over any other type of investment or security, including real estate. Millennials on average allocate 45% of their investment portfolios to fixed income, compared to baby boomers at just 31%. So if you're seeing a pattern here, it's that the Gen Z generation, or well, that sounds a little redundant, Generation Z seems to be taking more risk than the millennials. Now, the rule of thumb is the younger the investor, the more risk they should be taking. Gen Z home buyers were purchasing real estate during the 2020 to 2021 housing boom. Gen Zers had a tighter labor market with higher wages leading up to and during the pandemic, with the advantage of much lower mortgage rates and loose monetary policy. Millennials didn't have that advantage. They had to go through the hardships of recession after recession. Now, when it comes to work and living situations, millennials prefer to live near places of work in metropolitan areas where the cost of living and home ownership is significantly higher. Seattle, Washington comes to mind. As a matter of fact, it's one of the most sought after locations for millennials. I assume that would be because of technology and the tech sector. However, Gen Z, as I like to call them, the mobile generation, is a little more flexible with their work-living requirements as they entered the workforce during the remote work era, thanks to the pandemic, of course. They chose to live in smaller, more affordable cities and took advantage of historically low mortgage rates. They're more akin to the baby boomers in that they're okay with taking more financial risk. Even though, like I said before, I don't see real estate as a big financial risk. Even after the 2008 mortgage crisis, real estate bounced back in such a big way that if you had any money on the sidelines after that recession happened, if you were lucky enough to buy any kind of real estate right after that mortgage crisis, you made out like a bandit. You did very well for yourself. Congratulations, that was a smart move. However, not everyone is as lucky. Those who were unable or missed the opportunity to buy real estate during the era of low mortgage rates have an uphill journey to homeownership as home values remain elevated with little reprieve in sight. Current homeowners do not want to sell and they don't want to give up their rates. And who can blame them? But the real question is, moving into 2024 and even 2025, are we going to start seeing people sell their homes simply because they're realizing that they purchased a home that did not fit their lifestyle? I wonder, are current homeowners happy with their purchase? They purchased their homes during the housing boom to take advantage of low mortgage rates, with a lot of them paying well over market value, over asking price, I should say, just to get in those homes. But with a lot of people moving from state to state into completely different communities and neighborhoods, did they know what they were getting into? Do they like the community that they are currently a part of? Do they like the neighborhoods they live in? Is the home of sufficient size for them? I'll tell you this though, as long as home values remain elevated, I don't think they're going to lose any money. I think they will be financially stable. If anyone chooses to sell their home in this housing market to purchase another home, it's out of necessity. I think going into 2024, Gen Zers will continue to strive for home ownership, and they will forever change the real estate landscape with new ways of purchasing and selling real estate. Studies show Gen Z still relies on the expertise of local real estate agents, even though they are the most tech-savvy generation. I mean, millennials came into technology, but Gen Z, they grew up on it. I mean, if we're looking at all the resources that we currently have online to search for real estate, Gen Z has the upper hand, hands down. I mean, baby boomers barely know how to use Zillow. Gen Zers know not to rely on Zestimates and websites like Zillow's. They would rather rely on the expertise of a real estate agent and combine that expertise with the resources that they have on the internet. I think it's a great combination. And I think moving forward, we're going to start to see more auctions, more online bidding events. We're going to start to see ways of purchasing and selling real estate that both save the buyer money and is more effective for the seller at the same rate. Now, let's go over some housing data and get you up to speed on the latest numbers across the US and some local regions. Let's get into an index called the S&P Case-Shiller Home Price Index. Now, this index tracks changes in the value of residential real estate nationwide. The index, which has been tracking this data since 1988, as of end of September, is at an all-time high. I'm going to go ahead and pull up the graph here for you. Here's the chart, straight from the Federal Reserve. Home prices continue to trend upwards as inventory remains tight. And I mean, this is the most obvious conclusion we can come up with from this graph, is that home prices just keep moving higher. These ebbs and flows that happen periodically from quarter to quarter, those have to do with the change in the 30-year fixed mortgage rate, the federal funds rate, and bond rates. Now, why is the U.S. National Home Price Index, the Case-Shiller Index, so important? And the thing is, if you use this index as a benchmark, if you're an investor and you want to know what your investment in real estate should yield you on an annual basis, your best benchmark is going to be the Case-Shiller Index. Year to date, it has yielded a return of 6.08%. From here, 6.08%. Over a 3-year period, it has yielded a return of 11.25%. All of these returns are still better than investing in a 10-year Treasury bond or even a 20-year Treasury bond. I would much rather invest my money in real estate and bring home these types of returns on an annual basis. So if you're gonna go ahead and buy something like a single family home or a condominium or a townhome and rent it out to bring in some of that passive income, you want to use this as your benchmark. Minimum 6% return, and that's year to date. That's not even a 1-year return. That's year to date. I mean, you should be shooting for about 7%. That's at least what I get my clients. All right, let's move on to existing home sales. According to the National Association of Realtors, existing home sales has dropped to the lowest levels in 13 years. As of the end of October, home sales fell roughly 4.1% to approximately 3.8 million units. Most recently, the peak being in February of this year was at 4.5, just above 4.5 million units sold. It's important to note that existing homes are those that are occupied before coming onto the market. This index does not include any data from new home sales. This index is especially important because it tells us whether or not current homeowners want to or are willing to sell their homes. Not only that, but housing inventory remains tight. That's just going to keep pushing home prices higher. The third and final chart that I want to show you today is the Housing Affordability Index, which measures the degree to which a family can afford the monthly mortgage payments on a typical home, which peaked in February of this year, right about there, and the lowest level of affordability seen in August of this year, right about here, just a few short months ago. Now, the way this works is a value of 100, let's go along that line there, means a family with a median income has exactly enough income to qualify for a mortgage on a median priced home. Anything below 100 means that same family no longer qualifies for that same median priced home, meaning it has become less affordable. And as of September, affordability has slightly increased by about 1.8% from the prior month, coming back to levels last seen in June and July of earlier this year, indicating home prices may be normalizing or leveling out. But we won't know for certain until we have more recent data for the months of October and November. I will keep you informed as more data becomes available out of the National Association of Realtors and the Federal Reserve. That's all I have for you today. Check out my Instagram and Facebook page for new content and articles posted periodically by yours truly. Please comment, let me know your thoughts, and let me know if there's any topic in particular you are interested in exploring together. See you next time.